If you're just starting out in the stock market, you've probably asked yourself one big question. Should I buy stocks that grow fast or stocks that pay me steady dividends? It might sound like a small detail, but this one choice can completely change how your wealth grows over time. Pick the wrong strategy and you might spend years investing the hard way, chasing returns, getting frustrated, and wondering why your portfolio isn't growing the way you hoped. But pick the right strategy and you'll set yourself up to build wealth faster and more consistently, even if you're starting small. In this video, I'll break down growth investing versus dividend investing in plain English. We'll cover what each one means, who each strategy is best suited for, and how you can use them as a beginner without getting lost in complexity. By the end, you'll not only know the difference between the two, but also how you can apply them to your own portfolio. Let's get into it. When people talk about growth stocks, what they really mean are companies that are reinvesting their profits back into themselves to grow. Instead of paying cash out to shareholders, these companies use their money to hire more employees, build new products, expand into new markets, and push their business forward. Think of companies like Apple, Amazon, Google, or Tesla during their rapid growth phases. Investors weren't buying them for dividends. They were buying them because they believed these businesses would keep getting bigger and that the stock price would rise as a result. So, what's the upside of growth investing? You're betting on companies with the potential to multiply in value. If the company succeeds, your investment could grow dramatically. And the downside? Growth stocks can be volatile. Prices can swing up and down quickly. One bad earnings report or a slowdown in growth and the stock could drop hard. This is why growth investing usually works best for investors who have a long time horizon. And by that, I mean 10 years or longer. They don't mind riding out big ups and downs in the short term, and they care more about building wealth over decades than about steady income today. For beginners, the scary part about growth investing is figuring out which companies will succeed. You don't need to gamble on picking the next Tesla yourself. Instead, you can buy ETFs, exchange-traded funds, that bundle dozens or even hundreds of growth companies together.
Wow.
For example, there are ETFs that track the NASDAQ 100 or the biggest large-cap growth stocks in the US. When you invest in one of these, you're not putting all your eggs in one basket. You're spreading your money across multiple fast-growing companies at once, which makes it safer for beginners. Now let's talk about dividend investing. Almost the opposite approach. Dividend investing is about buying stocks from companies that regularly pay part of their profits back to shareholders in the form of cash. These payments are called dividends. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These are stable, mature businesses that don't need to reinvest every dollar back into growth. Instead, they reward shareholders with consistent payouts. So what's the upside of dividend investing? You get reliable income from your portfolio, even if the stock price doesn't move much. That cash can be spent, or it can be reinvested to buy more shares, which leads to compounding over time. The trade-off? Dividend stocks typically don't grow as quickly as pure growth stocks. Your portfolio won't skyrocket in value the way a high-growth tech stock might. Dividend investing is popular with the retirees who want income to live on, or conservative investors who prefer stability over fast growth, or just about anyone who likes the idea of their stocks paying them without having to sell shares. And just like growth investing, beginners don't need to figure out which dividend stocks to buy one by one. There are ETFs that focus on high dividend companies or companies with a strong history of increasing dividends every year. That way, you can invest in a ready-made basket of reliable dividend-paying stocks. No guesswork required. Quick note. If you're serious about starting your investing journey, I've put together a free masterclass where I show my full step-by-step system for building your first stock portfolio, avoiding beginner mistakes and growing it over time. You can watch it anytime using the link in the description. Here's something most beginners don't realize. You don't have to pick growth or dividends and stick with it forever. You can actually use both. A common way to think about this is the core and satellite strategy. This is one of the most popular portfolio building methods used by professional investors because it gives you structure while still leaving room for flexibility. Your core is the main part of your portfolio, the foundation that drives most of your returns. Your satellites are smaller positions that complement the core and help balance your overall strategy. Another way to think of it is like building a house. Your core is a solid foundation, while your satellites are the rooms and decorations that make the house unique to you. For example, if your main goal is income, your core could be dividend-paying ETFs that consistently produce cash flow. Then, you might add a smaller satellite of growth ETFs to boost your returns over time. If your main goal is wealth building, your core could be growth-focused ETFs. Then, you could sprinkle in some dividend ETFs as satellites to smooth out the ride and give you small amounts of income. This approach works well because it gives you flexibility. You're not betting everything on just one style of investing. Instead, you're creating a portfolio that balances both long-term growth and short-term stability. In fact, many investors find this mix makes it much easier to stick with their plan during tough market conditions. For beginners, this can also reduce the emotional stress of investing. Imagine if your portfolio is 100% growth stocks and the market drops 20%. It might feel like a punch in the stomach, and you could panic sell. But if part of your portfolio is made up of steady dividend-paying stocks, you'll still see cash coming in. And that income can help reassure you that your investments are working, even during downturns. Having that steady flow of dividends is like getting a paycheck from your portfolio, which can keep you confident and focused for the long haul. Over time, you can also adjust your mix. Maybe in your 20s and 30s, you lean more heavily on growth because you have decades before retirement. Then in your 50s and 60s, you gradually shift toward dividends because stability and income become more important. That's the beauty of combining the two. You don't have to pick one or the other. It's about choosing the right mix for where you are in life. To make this even simpler, let's walk through a few analogies and beginner-friendly examples. Think of your portfolio like a tree. Growth stocks are like fertilizer. They don't give you anything right away, but they make the tree grow bigger and stronger over time. Dividend stocks are like fruit. They don't make the tree taller, but they give you something to harvest every season. If you only use fertilizer, growth, your tree will grow tall, but you'll be waiting a long time before you see any fruit. If you only focus on fruit, dividends, your tree may not grow as tall, but you'll enjoy harvest along the way. Most investors do best by having both a healthy tree that grows tall and produces fruit. Here's another way to picture it. Imagine you're building two types of machines. A growth machine that takes in your money today and reinvests it to, hopefully, spit out much more money decades from now. A dividend machine that takes in your money today and starts spitting out smaller amounts of cash right away. Which machine is better? The truth is, neither is better. It depends on what you need right now. If you're young and your focus is retirement decades away, the growth machine makes a lot of sense. If you're closer to retirement or simply like the idea of cash flow you can see and use, the dividend machine feels more comfortable. And again, you don't have to build just one. You can run both machines side by side. One grows your wealth for the future while the other provides stability and income you can count on. No matter which approach you lean toward, the most important thing is consistency. The truth is, most million-dollar portfolios weren't built on lucky trades. They were built by investing steadily, month after month, year after year. Whether you prefer growth or dividends, the habit of staying invested and letting compounding do its work matters more than trying to time the market. It's far better to stick with a simple strategy and stay the course than to keep switching approaches every year. That's how real wealth is built. So now you know the difference between growth investing and dividend investing, and how you can even combine them to build a portfolio that grows while also generating income. The next step is actually putting this knowledge into action, and that's exactly what I cover in my free investing masterclass. Inside, I'll walk you through everything step by step, from picking your very first stocks to building a portfolio you can actually retire on. It's 100% free, and you can watch it right now using the link below. I'll see you inside.